Hi everyone, I'm Damien.
And I'm Jeremy.
Welcome to our Suburb Data Podcast, where we cover everything from property investing to expert busting. If you're new here, we share our personal and professional experiences from over 20 years in the game, so you skip the mistakes we made and go straight to property investment success. Jeremy, today, the 18-year property cycle. What historical data says the true cycle is.
Yeah, so there's this thing going around called the 18-year property cycle, and it's supposedly there's an 18-year gap between all the big booms in property markets. And it comes from a book written by a guy named Fred E. Foldbury, based on analysis of data from the USA, not Australia, USA. But for some reason, it's become popular here in Australia. And well, I thought I'd have a look at what the historical data has to say about national property cycles.
So we have slides, so this can be viewed on any of our podcast platforms. So let's look at what the data says.
Yeah, so here's a chart showing the per annum national growth rate. This is over the last 44 years. It's from the end of 1981 up to mid-2024. So in some years, you will see there's been some massive growth. The fastest national growth surge was in the late 80s when growth peaked at about 31% per annum. And the horizontal white line that you can see there, that's the no growth line. That's when the growth was 0%. And when the turquoise curve dips below that line, it means property prices are going backwards, and this is nationally. So not everywhere, but most places. And of course, some places would be worse than others. Now, the worst national growth rate was in mid-2012 when it was around about minus 5.5%. And growth nationally went into the negative 5 times over this period. And the gaps between those troughs, it varies from over a decade in one case to less than 3 years. And so the chart goes up to mid-2024. You can't see that in the bottom right-hand corner. Sorry, it runs out of space there. But I can tell you that it does go up to mid-2024, and that figure is 7.7% per annum currently.
So interesting, the growth rate dropped off significantly at the back end of 2021. Is that right? Is that like sort of after that COVID period, around the COVID-ish period?
Yeah, so we had those historically low interest rates. People started capitalising on that, realising this might be a bit of a storm in a teacup, and started buying up real estate. And all of a sudden there was a boom in prices.
Well, that's the COVID over here, isn't it? The decline, and then you've got that increase, but then that's when property prices, it seems like a big drop, isn't it? Oh, that's per annum though when you look at it.
That's right, yeah.
So it's going to fluctuate.
It is over a year or two there.
Because if you looked at total growth, it'd most probably be a bit more like consistent upwards or up and down.
Yeah.
It'll be sort of hover, wouldn't it? Like a line of best fit.
It fluctuates from era to era, good eras and bad eras. You have positive growth and negative growth, and that's what this is showing. Yeah, so it's not a cumulative growth, it's a per annum growth rate.
Per annum. Okay, moving forward. So what does this next slide show?
So in this slide, I've added 2 new horizontal lines. The purple one is the long... I've been informed it's lilac, actually. It's not purple.
Lilac,
yeah.
Okay.
So the lilac line is the long-term national average growth rate over the entire period. And it works out to be a bit under 8%.
That's for the last, 44 years. What am I doing? 44 years.
Yeah, but I wouldn't read too much into that. I wouldn't use that as some sort of benchmark for the figure. For the future, that figure can fluctuate quite a fair bit, depending on the era that you're considering in your calculations. So, for example, it works out to be only around 6% per annum if you consider the last 35 years. So a slight change there, and you get a big change in the average. But anyway, I'm going to use that as a benchmark.
Well, it's around what at the moment, the last 10 years per annum is around that 6 to 6.5% growth per annum.
I don't know what it is over the last 10 years. I haven't looked.
I look at all the time. It's the LT. Is? Yeah, it's the LTG
long-term
metric.
growth, right.
That's the metric I like to look at. So if an area has had significant growth recently, it's obviously been factored into the demand to supply ratio score. But yeah, maybe it's just one of those ones where I might be like, oh, if I've got 3 areas I'm going to invest in, maybe the higher ones that have had more growth, the probability that you're going to get more growth in the future is going to be lower.
Yeah, it tends to swap. So if the last 10 years has been good, next 10 is probably going to be poor and vice versa.
And for investors, like when you're, I guess, comparing, or let's say you're using a buyer's agent service, or even if you do it yourself, you want to make sure that you're comparing yourself to a benchmark. Similar to if you've got a share portfolio, you might be benchmarking against a specific index, like what a lot of financial planners do. But the way I would be reviewing my portfolio is every year, grab a valuation from a broker. Desktop's okay. You can do a full val, or you can try and come up with an estimate of what you think the property is. But are you beating the national growth rate? Is my investment? And if not, you need to say, okay, do I sell that property or not? That's for future episodes.
Yeah, we'll talk more about that in the future. There's another line that I've added here, the yellow one at the top. That sits at 25% per annum. Now, if we define a boom as 25% or more growth, then there have been 3 booms in the last 44 years. Now, the first was in the late 80s, the second was in the early noughties, and the third was post-COVID, which we talked about in the early 2020s. And the boom that you see in the early 80s on the far left of the chart, that didn't qualify for this definition of a boom if we are using 25% as the definition of a boom, and we'll come back to that in a minute. Okay, so the gaps, if you go to the next slide, excuse me, so the gaps between the peaks of those 3 booms are 13 years from 1989 to 2002, and then 20 years from 2002 to 2022. Now, if you took the average, it would be 16 and a half years. So definitely no way we can get to an 18-year cycle, and there's no consistency between those gaps either, but it's an extremely small sample size. We've only got 2 gaps to look at, so unreliable anyway, even if it was perfectly an 18-year cycle. But what if we change the definition of a boom? So I've defined a boom as 25% or more growth. If we used 30%, we've only got 1 case, so we can't measure a gap at all. It just didn't occur again in history. So the only way in which we can get something different is if we lower that yellow bar. And if we change it to a minimum of 20%, we get the next chart. Okay, so you can see the yellow horizontal line now is at the 20% mark. And that gives us 4 peaks that we can analyse to see what that cycle is, what's the gap between each peak. So we've got 4 peaks, there are only 3 gaps. And the extra one we've got there is the one on the left, which was in 1982, the far left. So the gaps now are 7.5 years, 13 years, and 20 years. So the average is now 13.5 years, which is a long way off 18. And again, there is no consistency that we can rely on to say, hey, this is a repeating cycle. So the smallest gap is around 8 years and the biggest is around 20 years. That is a huge variance.
So I might have missed it. So that 18-year cycle wasn't done by an economist in Australia. It was overseas, wasn't it?
Based on USA data, but Australians are looking at it and going, ooh, we've got something here, or we can use this, or I don't know what they're thinking. I don't know if they are thinking.
How did you hear about it, that like investors are listening to it?
I've heard it on podcasts and blog posts and email newsletters. Yeah. Thought it was about time to debunk the myth. Yeah.
Nice.
And I'm not the only one. Some others have looked at this historical data and gone, what are people talking about? Why are they talking about this 18-year cycle? Now, if you have a look at that chart, you can see that if we drop down to a benchmark of 15% per annum, it wouldn't change anything. We'd have the same 4 peaks. So the only next logical one is if we go down to, say, 10%, and that's what I've got on this next chart. So here we see it's barely above 8%. It's really getting close. But this is the next possible logical option. So we've got a 10% per annum growth rate, which is defining a peak, which we use to measure the market cycle. So now all of a sudden we've got 9 peaks marked by those yellow ticks there, and the average gap between them works out to be 5 years. And in some cases it's as small as 2.5 years, and in other cases as wide as a decade. So there is no consistency at all that we can rely on. We've got a slightly larger sample size that we could argue is reliable. I don't know. Basically, I'm not getting anything out of this. So as you can see, there is no general rule that we can rely on regarding some national growth cycle. Each cycle is different from the one in the past, and there are simply way too few cases to come up with this sort of general rule. And anyway, how would you use it? Like, let's say there was an absolutely bang-on perfect 18-year cycle. What are you going to do? You're going to invest once every 18 years and you're going to buy a property anywhere in Australia? It just it doesn't really make any sense. You've got to buy a property that's in a street, of a suburb, of an area, of a city. Like, when there were those troughs in that chart, when there was negative growth, there were some suburbs around Australia that were having positive growth. And when there were peaks, there were some suburbs around Australia that were having negative growth. So because the markets are so diverse, you can't just buy anywhere, and you can't buy all of Australia. There's no index that you could buy into. So it's a poor strategy. First of all, there's no basis to it. And then secondly, it's just a poor strategy because you're only investing once every 18 years. And where? Anywhere?
I think the main thing for me, or my key takeaway, is always try and be invested in the market if you can afford it. And, because property is a set and forget type strategy. You buy it, you want to sort of forget about it, don't you? Because time is precious. So I would think that you might have a couple of those stable investments, and then I know it's going to feature in one of our future episodes, but potentially some trading. Maybe you've got 1 or 2 stable properties in the portfolio, but maybe that third or fourth one, you want to try and get in the market, and then maybe time to try and sell out if you want to be a bit more active. So it just depends on the type of investor that you are.
Yeah, there's definitely opportunities there. And a lot of people will say, oh, but aren't you losing all your money paying capital gains tax and agents' commission? You do lose some, but you don't lose all of it. And so long as the opportunity cost exceeds the recycling of equity cost, it can actually work out to be better.
I'm looking forward to that into the future, that episode.
Yeah, so just wrapping up
Conclusion?
this one, it's a peculiar sort of theory. It doesn't hold true in Australia with our historical data. There's inconsistencies in the gaps. There's nothing near 18 years. It's not a good idea anyway. It's not a good strategy. You should be looking for the ideal suburb to invest in because you can't buy all of Australia. I just think it's complete bunkum. But as you saw in those charts, you could say that there's a 5-year cycle. Write a book on it. Bingo, you're an expert. Now you can sell some stuff.
It's all subjective, isn't it?
Yeah, very
you
subjective.
can manipulate the data in any way that you can create a story from it, can't you?
Yeah, well, you saw how I lowered the bar there to get a different cycle. So it's arbitrary what percentage you choose to define a boom, but you can take your pick and publish it and call yourself an expert.
Wrapping up, so where can listeners go for more resources, Jeremy?
Well, if you want more of this sort of stuff, you can click subscribe and you'll be notified. Give us a heads up whether you like this sort of thing with a like. And if you think someone else who's been propagating some nonsense like this around the place needs to hear something like this, well, there's a share link to make it easier.
Yeah, if there's any analysis that you'd like us to do, more than likely Jeremy would do it. I might do some depending on where it is. But like, you can email us on podcast@suburbdata.com.au or just leave a comment. But subscribe, like, share to the world. Thanks for tuning in. See you in our next episode. Take care and bye for now.